All right, Hayden, go.
All right. Okay, we're starting. All right, gentlemen, time to be PC. We're live. All right, so okay, so this presentation is covering essentially the basics for personal finance 101 and FIRE. It was basically influenced by spouses asking for a spousal introduction to like, what the dude's stonk chat is, and so
Yeah, Heather's
this
been
is
pissed about it. She's like, how come I can't join?
Oh, it's
well,
not allowed.
we can like so
When we
we'll go
start
over
doing
this.
when we start doing in-person meetings, they can attend and bring us treats.
So
And
what
rub our
I'm
feet.
thinking is like this is right here is going to be like a first round like demo of what we can present them. Um, some of them will have like most of these concepts down, if not all of them. And eventually we'll probably get into more advanced stuff, but this is kind of like what you begin with when you start on this journey. So, personal finance 101 and FIRE. Some of this is likely not new to you, but any questions or feedback throughout the presentation is welcome because I just made this in like an hour. So, moving on. Disclaimer, I'm not a financial expert. I just pretend to be one. The advice in this is specific to people in the 25 to 35 year range. It's also more specific to how I do things. You'll find different opinions when you go out to other people's blogs or other gurus, but this is how I do things. So it's specific to my risk tolerance. If you don't have a high risk tolerance, adjust it to your personal risk tolerance. There's ways to figure out what your risk tolerance is, and that's really just a Google search, and you'll find some kind of calculator. Also, always do your own research before taking advice from an idiot like me. That should be clear. And this is not comprehensive. This is just high level. Any questions before we continue?
Yes, two questions. One, why aren't you a financial expert? And then two,
Because I'm a liberal arts major.
no, that's not important. And then two, why does it only pertain to 25 to 35-year-old people?
Good question. So as you get closer to retirement, or as you have more kids, you just want to save up for their college, etc., life events occur, your risk is likely to go down, your risk tolerance, and you kind of have to change your strategies the older you get. So this is for people that are a little bit into their career, not too far, but want to get ahead of their peers. Answer your question?
Yep.
All right, going on. All right, so some quick concepts. I'm sure a lot of you guys are already familiar with these. FIRE, financially independent, retire early. That is the #1 goal of this chat. Retirement accounts, that would include your 401ks, IRAs, Roth 401k, Roth IRA, so variations of that. Taxable accounts, that's your standard brokerage account. Capital gains, profits you make from the sale of an asset. And then you have ETF, which is an exchange traded fund, similar to an index fund. I didn't put that in here. Index fund would be the same thing, but it's not something that you can it doesn't adjust and fluctuate throughout the day. It's calculated at the end of the day. It's managed by an individual or group of individuals rather than essentially a algorithm. Resources that are very helpful when you're on this FIRE journey or just looking into personal finance would be Reddit's Personal Finance. They have an excellent wiki. Financial Samurai, probably my favorite financial blog. And then Investopedia for any concepts you're not familiar with. All right, so the agenda. First, we're going to go over setting goals. Next, we will go over building emergency funds. Third, tackling debt. Fourth, contributing to retirement. 5, taxable accounts. And 6, investing.
Can you consider adding anything by Dave Ramsey to references?
Hey, shout out Dave
No,
Ramsey.
I'm not a big Dave Ramsey fan.
Fantasy
He has
fan.
great
I like
concepts,
his
but
debt snowball
yes,
concept.
exactly. And I kind of brief over that, but yeah, no. When it comes to debt, like he's the dude. But when it comes to other stuff, we'll get into it as we move on. But like he's more along the lines of always invest in, you know, like a broad index fund like SPY and shit like that. And I have qualms with that, which I'm going to cover. But from a high level, it's just too weighted by the top 10 companies. All right, so setting goals and budgets. So first, you want to set a savings goal. So a lot of experts will tell you to first go into your financials, figure out what your expenses are, and then figure out what you can cut based on necessities versus entertainment. I disagree with that approach. I don't like looking at what I have to cut out. I'm more of a fan of setting a savings goal that's attainable, and then just the second I get a paycheck, I put that into, you know, a savings account or my brokerage or anything similar. And then I don't have that money to spend because that forces you into a budget rather than trying to figure out what you can and can't do. So you set your savings goal, you implement your savings goal, and over time, as you get better at finessing it, you increase that savings goal. So here's a quote by a famous person. When I was messing with the slide, it had a famous person's quote in here. So, don't focus on cutting expenses. Focus on implementing your savings goal. It's easier to add money to an account and not have shit available to spend than it is to not spend money when you have it. So, whoever wrote that is a fucking genius.
Yeah,
Is his name Drayden Drano?
It rhymes with it.
Oh man, I was close. Hold on. Don't focus on cutting expenses. Focus on implementing your savings goal.
That's what I do too, if anybody's curious.
Yeah, it's way easier. So
Yeah.
Less math.
yeah, less math, and like if you get a
I just look at
paycheck
it-
and you immediately put it into a savings account, you don't have that or your brokerage, you don't have that money anymore, and then you can focus on what you have to spend rather than, you know, spending money and be like, oh, I can't do this, and if I want to hit that savings goal, so just force yourself into that savings goal.
I was gonna say basically
Yeah, so
you're forcing your own hand to not be retarded.
Exactly.
Okay.
You want to manufacture scarcity, basically.
That's a great way of putting it.
That's like an educated way to say it.
Yeah. Well, a little too smart for this call.
Yeah, Messine, I need to get the lay of the land really quick, dude.
Welcome, Mac. All right, moving on. Next, building an emergency fund. So an emergency fund should be relatively liquid, and it's money that you don't touch unless an emergency comes up, something unexpected, you know, medical bill, something in your house gets fucked up that you have to, you know, pay for. So, general consensus when you're doing this is to take a year's worth of expenses, divide it by 12, and then you have your monthly expense on average. The experts tell you to save until you can safely cover 3 to 6 months of expenses. That also covers if you like lose your job. Now, I personally for this, I'm a little on the lower end when it comes to this because I figure I can always sell, you know, assets. But what I don't do is put money into a savings account. Savings accounts have terrible interest returns. It's like less than 1% on most, I think. So I actually put mine into a money market. Yeah. And a money market will give you better returns, and it's FDIC insured. So, you know, if it gets hacked, you'll get your money back from the government. And it doesn't fluctuate. Like if you were to say put it in like bonds or stocks, the price isn't going to fluctuate, but it has a higher interest rate, and that's based on whatever the Fed sets.
What's an example of a money market?
So I would say like the perfect example is when you have a brokerage account or even a retirement account,
So
the
Schwab,
money,
Vanguard.
Schwab, Vanguard, Fidelity, all those, when you have your money on the sidelines, like if you're sitting on cash in your account, in most cases it's actually in a money market, and you'll get better returns in that account than if it were in a savings account.
That's true for Vanguard.
Yeah. It might
Okay.
depend on the Vanguard account that you have set up, but you can also open it, like if you're with the credit union, you can also open up a money market with them. I use Navy Federal, and I can, instead of using the savings account that you are forced to have when you open an account with Navy Federal, I opened a money market, and I can quickly transfer funds between checking and money market seamlessly, just like I would with a savings account.
See, that's smart because I was just gonna circle back to manufacturing scarcity per machine. If it's just sitting in a brokerage account, you're tempted to throw that all on AVML and lose it tomorrow.
Yeah, 100%. And so like right now, as an example, we have a surgery that's likely to come up for Waldo, so I put a little extra in my money market to cover those expenses, whatever they might be. Don't know what it's going to cost, but just a personal example.
I'll
Hey,
do
do
the
you have
surgery. I'll do the surgery for half price for Waldo.
do you have pet insurance, Hayden?
I do have pet insurance.
Okay, I
True
was
Canyon.
wondering. Keep me posted on how the coverage is on that because I haven't had to use it, and I'm paying. It was like $60 a month.
Yeah, well, I guess sidebar on that real quick. So we got Waldo X-rays recently, and like the total cost came out to 800. Plus we had to get like medicine and shit for him, and they covered 500 of it. So
Oh, nice.
yeah, so not bad.
Yeah, hell yeah.
Next, tackling debt. So this is a topic a lot of people don't like hearing about, but it's very important when it comes to becoming financially independent. So essentially, you want to address debt as soon as possible, as it does postpone the journey, and depending on the interest rate, debt compounds similar to investments. So it's something you really want to look out for. A general rule of thumb is if you have debt with an interest rate over 4 to 5%, you should pay that off as soon as possible before you start stocking away money, not counting retirement accounts, and I'll get into that. So debt isn't necessarily a bad thing. It's a very powerful tool. So if you have a low interest rate like the current rates for mortgages, you're better off just paying the minimum on those payments, because the investments that you throw into the market are likely to compound a lot quicker and have a better rate of return than whatever the interest rate is that's compounding on your mortgage or any other kind of debt you have. But once you start broaching that 4 to 5%, it's best off to just pay that debt and get it out of the way as quickly as possible so you can start, accumulating capital and building up that net worth. And I also want to make a note, I don't have the math in front of me, but there are calculators out there. Depending on your income bracket, it might change on whether or not you should pay off the interest on your mortgage or something else. Assuming that you have a low mortgage rate, it might be beneficial to actually pay that off before investing it. But I don't think any of us fall into that category. But just something to be aware of. Like I said, general rule of thumb: if your interest rate on your debt's over 4 to 5%, you should probably just pay that off ASAP. Any questions around this?
Nope.
I had a question about the last slide.
Okay. Shoot.
I'm just kidding. It's a troll.
Okay.
Aside for emergencies, like when you see Green Bay -7 against the Bears.
Okay. We're moving on. All right. So 401ks and IRAs. So we covered the whole debt issue and the emergency fund issue. So you want to get that emergency fund, you want to start tackling debt, but at the same time, if you have a employer-sponsored retirement account, at the very least, even while you're tackling debt and all that other kind of shit, match your employer's minimum.
How do you feel about matching, let's say your employer only matches 25% of what you put in?
I would. Oh, good question.
Is it
At the
up to a
very,
max percent?
yeah, I feel like it most likely is. Is it not up to a max percent?
So mine is they match 100% up to 3%, and then up to 5% they match 50%.
So if I
So
were
I
you,
match up to 5.
yes, max up to 5. You want to get the most out of that max that you can
Free money.
because it's free money. And it's growing tax free. It doesn't get taxed until you pull it out. I'll go into the differences between like the 401k and Roth. But yeah, at the very least, you want to get that minimum or maximum, whatever, from your employer because, like Derek said, it is free money. Yes,
Yeah.
you're working for them, but it's an optional choice, and the more money you can get, the better off you are. So 401ks and IRAs are a great tool to build wealth. Currently, contributions for traditional 401k or IRA allow you to lower your tax burden. That might be changing with the Biden administration. We don't know yet. So an example of that would be, let's say you have Sally. Sally makes 100K a year and contributes 10K to her 401k. She's actually only taxed on 90K for that current tax year. So 401ks and IRAs are a great way of also reducing your tax burden. And if you can throw that money into something that's not taxed until retirement, like you're better off, right?
Do you know
So
what the contribution limits are?
yes. So the 401k maximum in 2021 is $19,500, and the IRA max in 2021 is $6,000. So if you're in a position where you can max that stuff out to lower your tax burden, and you don't
Is
have any other big
6,000?
expenditures coming up, you're good to go. Would you say?
Is 6,000?
Yeah, 6,000 for an IRA in 2021.
And further, this is very scarce money. It's a pain in the ass to touch.
Yes. Yeah, also keep that in mind. Your 401k and IRA outside of emergencies, you're better off just not touching it because there are tax penalties if you pull from it. This is shit that you really can't touch until I think you're 59 and a half
Without paying penalties.
without paying penalties. Keep in mind also for a traditional 401k and IRA, you will be taxed at retirement when you start taking money from it. But it's growing tax free, so that's something to keep in mind, and it's lowering your current tax burden.
But isn't the idea that you pull it out when you're not making as much money?
The idea is to pull it out when you're retired.
So you won't get taxed as heavily.
Exactly. Well, we don't know what the future has in store for taxes, but that's really the concept, yes. And then you have Roth IRAs. So a Roth IRA or a Roth 401k is money that you can put into a retirement account. That money is taxed when you put it in, but it is tax-free when you pull it out at retirement. And there are other nuances with it, like you can borrow against it as long as you pay that money back by a specific amount of time. I don't know the full details of it. And another thing on Roth 401ks and IRAs, there is a salary cutoff, so if you start making some decent cash, you can't put money into one. There are backdoor ways to do it, but I don't know those backdoor ways, and it's not really something I'm interested in. I'd rather just have it in my brokerage.
So, question for you, and I don't know if you know the answer, but once you hit that threshold where you can no longer contribute, are you allowed to just maintain
Yes.
current Roths?
Yes, you can maintain it. And then lastly, if your employer is a dick and doesn't provide a retirement yeah, just like any kind of retirement plan. I would suggest that you set one up yourself. It's really, really simple. Just go with Vanguard or Schwab and just fill out some bullshit, set up your own IRA account, and then contribute to that and lower your tax burden. It's really not hard to do. And then when it comes to investments in a 401k or an IRA, I would just stick to target dated retirement ETFs just to make it simple. You can start getting a little more advanced with your plays on it, but I wouldn't suggest doing that until you have a specific net worth, which I'm going to cover in another few slides. So
Probably especially too if you're already playing around in like your own
exactly,
account, right?
yeah. Like when it comes to 401ks and IRAs in general, until like you have like a really meaty net worth, you really just want to be passive as fuck. Don't make trades in it that you don't need to. Just go with some easy funds or mix of funds and just let it ride. Because you're not getting that money in, I don't know, like 40 years, maybe 35 years. So just let it ride, let it do its thing, compound, all that fun shit. Any questions on this?
For an example, my 401k is divided into quarters. It's large cap, small cap, growth, and international. International is a debatable play, but it's just
No,
for
I
diversification.
I think it's a smart play. In fact, I think I'm currently sitting like at least my stock blend is like want to say like 60% US, 25% international. And then like just look at the growth of China and the Asias and eventually Africa. Like those are going to be powerhouse economies in the future. So just it's good to get exposure to everything. I don't think we'll ever see America in our lifetimes fall off, especially since we have population growth and a lot of those other countries are shrinking. But it's still good to get exposure everywhere because you never know what the future has in store. But one thing is for certain, don't bet against America. You're a fool to bet against America. All right, taxable accounts. This is my favorite. So there's a few things I want to cover with taxable accounts. So depending on a length of holdings in your taxable account, you will be taxed differently. So if you're holding shit under a year, you're going to be taxed as normal income on your profits, that is. And then anything over a year, it's taxed differently. It's called long-term capital gains, and I have a chart in the next slide that will show you how that's taxed. This is where most of us, for those of you not familiar, do our YOLOing in trading. And it's when you start messing with taxable accounts, it's really good to have a strategy and actually stick to that strategy. Tax loss harvesting is really smart when it comes to these. Setting stop losses, Masin was talking about that, I think on Thursday in the chat. Averaging down, averaging up, all solid strategies depending on what your goal is. So I don't cover anything advanced in this deck, but it's just good to get a strategy and stick to it. So when it comes to taxable accounts, basically once you've accumulated your savings goal and you're tearing it up in your retirement account, you've paid off high interest debts and anything fun like that, this is when you want to open up a brokerage account and start, making some side flow. Also, I kind of spoke to it, but keep in mind you are only taxed on your profits. So an example of that would be like if I buy a stock at $10 and I sell it at 50, I'm only going to pay tax on the $40. The $40 that I made off of that $10 investment. So because I sold it at 50, that means I gained 40 taxed on that. Also, you can write off up to 3K in losses a year. Sometimes it's good to do that in down years if you really want to lower your burden on taxes. Other times when it comes to tax loss harvesting, maybe you have a bunch of winners and you have a loser that you want to get rid of. You can just dump that shit and lower your tax burden. So yeah, you're really only paying taxes on this shit when it's profitable.
Do you know if you can do that on a simplified W2 or whatever it is? Like not an itemized.
I don't know how that works. One thing though, like all these brokerages nowadays, they do all the shit for you, and like you print it off and you can plug it in. It'll give
Yeah.
you like everything, like it'll itemize it and all that kind of shit for you. So
And I get
it's
at the end of the
generally
year,
not a worry. Yeah.
they send you the, I think it's a 1099, right?
It depends on what you're invested in, but yeah, it's a 1099 or some variation of it. OD, T, there's a bunch. Yeah. No, and we won't be getting it for another few months. Yeah, for a lot of brokerages, yeah. Well, lucky you. I usually have to wait till like mid-March.
I think John's talking about a W2.
I think he is
W2,
too.
yeah.
Yeah.
Yeah, I've never done the 1099.
Hey, John, keep in mind with Robinhood, you're going to be getting an email or something, and you're going to have to print that off for your taxes because you do need to report this shit, and it's very
Yeah.
important that you do.
Yeah. I think I've only made like 1,200 or so.
I didn't report it
you
last
gotta
year.
report that. Yeah, well, you might want to do a back report, because you don't want to get fucked.
Nah, Johnny,
The
thank you for your
penalty
service, bro.
fees and interest on it are really high, so yeah, I don't think you'll be punished as harshly if you like backtrack and report it after the fact, but it's
Yeah.
just make sure you report this shit.
They sent me an email already
Okay.
about my stuff, I think, but I haven't really looked at it because I haven't got my W2.
I
Okay.
think you should risk it.
I mean,
Yeah, prison time.
like,
All
like,
right.
I
if you
did tell
gamble?
him I was on a ship. I couldn't do my.
I actually was on a ship when I filed my tax return.
Okay, so just quickly going over long-term capital gains. Most of you are in the single. Pretty soon, Cause will be in the married filing jointly. So here's like the three brackets. So your tax rate based on income. So if you're making under $40,400, you're not going to pay tax on long-term gains. Keep in mind, this is something that's held over a year. Okay. Short-term capital gains, it's taxed as income. Long-term, which means you held the security for more than a year, these are the tax brackets. So 0% for single people, up to 40,400, married 80,000, head of household 54,000. I really don't know what head of household really entails. So
You got like 5 dogs and
No, see, it's like single mother, or if there's one adult working, kind of a deal.
okay,
Yeah.
I don't know why you wouldn't just married filing jointly, but whatever. Single, 40,000 to 400 to almost 450. So here is where most of us lie. Maybe there's an outlier that has an income over 500. If
Yeah,
so,
me.
this chat ain't for you.
Okay, well, hold up. Is this based off of income or based
This is
off
based
of
off
gains?
income. Income,
Oh,
yes.
okay.
So basically, this is why you see rich people paying an overall, lower tax rate than us peasants. It's because most of their money is being made off of investments and long-term holdings rather than just a salary. So, like say like Jeff Bezos, I think his salary is like 100K or some shit, and most of his income and wealth is being generated from stock. And so when he's selling it, he's only paying in this 20% bracket. Whereas, you know, some of us are over the 20% bracket because we have salaries and all that kind of shit. So,
Well, so if he's salaried at 100K, wouldn't it all be at 15%?
well, I'm assuming he's making income off other shit too, but I don't know. Yeah. But yeah,
This
this is,
wouldn't push you to the next bracket if you had a hell of a year on your long-term investments. This is
for long-term
purely
investments,
a
no, but if you're doing a
W2
lot of, but
type.
keep in mind, if you're doing a lot of short-term trading, it's gonna boost your income because that's
Yes.
taxed as ordinary income. So like, if I do a bunch of short-term trades, I make 100K plus my household salary. That might bump me up versus, you know, like if I only sold long-term holdings. All right. Next. So, what should I invest in? This is specific to your first 100K. Once you pass 100K, you can look into more advanced strategies. Keep in mind, this is my input. Other people might disagree with me. Some people might say, hey, you should do this until you hit 1 million. Others might say, fuck this, I don't care. Like, I want to do other more advanced strategies, but I think the safest way to do this is once you hit that 100K, break out into more advanced shit. Until then, just, you know, don't get too complicated and fancy with it. So when it comes to accumulating your first 100K, here are some investments that I personally think that you should look at. They have low expense ratios and they're fairly solid on what they track. I do have some grievances that I kind of went over earlier on how they're weighted, but I don't think that's a concern until you start making more or until your net worth has built up more. So the first one, VTI, that's a Vanguard Broad US Market ETF. Then if you want one that's benched against the S&P 500, SPY and VOO are really good. VWO, Emerging Markets ETF, that's a great one. Gold for your alternatives, and I can kind of go over that in the next slide on why I like alternatives. You also have REITs, which I didn't put on here and I should have. IWM, it's a great small cap that follows the Russell 2000 index. And then BND for your total bond market ETF. So I kind of broke this out into 3 things on basically on risk tolerance. So if you're high risk, I say, you know, you want to put more towards stock and alternatives. Alternatives include, you know, like I said, gold, which would be materials, REITs, which are your real estate investment trust funds. They tend to have really good dividend payouts too. So keep that in mind too. When it comes to dividends, you are going to get taxed on that when you receive those dividends. And then bonds are usually pretty low when it comes to volatility, but they have shittier returns. So yeah, the lower risk you are, the more bonds you're probably going to want to buy. And then the higher risk you are, you know, more into stock and alternatives. When it comes to my alternative breakdown, I have 0.05 Bitcoin, huge investment right there. And then I have quite a bit on REITs and a little bit in gold, and that's more of just the gold is an inflation hedge, and then the REITs, it's, I mean, who doesn't like actual assets, right? So
Gold also tends to be inverse to market movement.
tends to be, right?
REITs are also interesting because like they're not necessarily just like, you know, homes or commercial real estate. Like data centers, a lot of them are actually REITs.
Yeah, server's a good data center REIT. SRVR. I think the fees are high though. Sorry if I cut you off.
Oh, no.
But yeah, so just Be realistic about your risk. Because, like me personally, if I see my net worth drop 40% a year, I'm not going to panic. I see that as a buying opportunity, and I'm just going to buy up more assets. Other people will panic and then sell, and that's the worst thing that you can do. So you have to do some soul searching and really understand if you're okay with high risk. The way I look at it is, there's going to be really shitty years, maybe even back-to-back years. Maybe it'll take a decade to get back to where I was, but high risk, generally, over the long run, you're going to have better returns. And the younger you are, the easier it is to be high risk. But as you get older, you're probably going to want to lower your risk exposure. But yeah, like just I can't emphasize it enough. You really, really want to be honest with yourself when it comes to risk, because some people will see something tank, 10%, and they're going to panic. Others will see something tank 50%, and they're not going to sweat it.
Yeah, if you retired in February and you're living off of your retirement accounts, and then March 18th hits, you're kind of fucked.
Right, and that's when you like the older you get, you really want to diversify and kind of switch up your strategies. All right, next. This one is for the gambling connoisseur. So, when it comes to this stuff, and I guess this kind of falls in line with risk, don't bet more than you're willing to lose. A lot of us are playing options, and that it's a great example of not betting what you're willing to lose. Like, for some of us, like $1,000 gamble is nothing. For others, it'll make them sweat, and they don't want to gamble more than $100. So don't do that. Don't try to play keeping up with the Joneses. None of that shit. We're all here to build each other up, and make sure that we can all hit that financial independence and enjoy retirement or whatever comes next, together. Personally, to me, what's up?
I said a lesson I've learned is you never want to chase a gain. That's when you lose big.
That's good advice too. Yeah, and I'm guilty of doing that. Personally, to me, I don't gamble more than 10% of my portfolio. So the trades that I'm often, like talking up or talking down, when it comes to the Stonks chat, I'm not gambling more than 10% of my portfolio. I've built up my net worth, in my other accounts, and now I've gotten to a point where I have some side money to gamble, and I don't go more than 10%. I don't put any more money into my trading account. I'm hoping that I can just grow it on my own. Everything else goes to, my hands-off brokerage or, retirement accounts and all that kind of shit. House, I guess you could say. But yeah, I personally think like most of us are never going to, we might be able to beat the market some years, but to do that back to back to back is, I think, like 15% of experts actually beat the market. So just realize, like, yeah, we all want to, make our stock picks, all that kind of stuff, but I strongly suggest don't do more than 10% of your portfolio. And then also realize we all lose out on stonk picks and plays. Like I've lost countless times. I've won a lot of times. I've gotten better at it over time. Don't expect to be an expert right out the gates. None of us are. I think my first year was not that great. My next year of trading, I got lucky. This year was fantastic. I doubt we'll ever repeat a year like this, but you never know. But yeah, just be okay with losing, essentially. And then when you win, don't get cocky. The worst thing that can happen is you make your first play, you get 1,000% off that, you think you're a fucking genius. It's honestly better to lose your first few plays than to win, but I still want everyone to win. So.
Yeah, what they say it's easier to lose than it is to win, right? Because
Yep.
I mean, if you lose 90% of your portfolio value, you need to increase it by 1,000% just to get back to even, I think.
Yep.
To go from 1,000 to 100, yeah, you got to increase now. You've lost 90, and now you got to grow 1,000. So you got to grow 10x just to get back to where you were before. Pretty
Yep.
tough.
Very tough. Yeah, and just and this also comes down to like risk tolerance. Like just don't gamble. Like 10% is just a number personal to me. You know, maybe some of you want to gamble more. I would advise strongly against that, but you know, you are your own person. You do whatever you want, but just in general, uh, just make sure if you lose all that money, you don't need it and you're okay with it. All right. So after your first 100K, I'm not going to go too in depth on this, but this is where I think you should really diversify your funds. And I'm not talking about your retirement account. I'm talking about your brokerage account more so. So the personal problem I have with a lot of those broad market ETFs like SPY, QQQ, VOO, is that when you look at what their holdings are, the top 10 companies are almost a quarter of the weighting. So if I go out and I buy SPY right now, like you know, like 7% Apple, I don't know how much Tesla is now, but you're essentially putting a lot of money into the top 10 companies, and they're not always going to be top 10 companies. So I started, and I guess there are faults with it, but more on the stock picking end of, you know, I try to have a somewhat even breakdown of every industry. So you got like consumer discretionary, technology, healthcare, financials. There's like 10 big ones, and I try to pick companies that are in that. I think it's called modern portfolio theory. Uh, for some homework for those of you that are curious. But I strongly believe that, you know, once you start making money, it's okay to still have money in ETFs, especially your you know, your 401k or IRA, but you want to start diversifying, because there's some years where one sector shoots up, one sector goes down. And as an example, if tech goes down next year, or I guess this year, um those broad market ETFs are going to take a huge fucking hit. They're going to tank because it is so technology heavy, so healthcare heavy.
So
So
question,
yes.
would what you're talking about right now would still be outside of your 10% gambling, quote
Yes.
unquote, funds?
Yes, this is
It's
outside of
just
my
you're creating your own
yeah.
index
And
potentially.
I went with a fiduciary. I hired Personal Capital to do my tax loss harvesting and implement modern portfolio theory for me. You can go with robo advisors as well. They tend to be cheaper. I wasn't impressed with what I was seeing, and I didn't want to have to do a lot of the manual lifting myself. Um, but and a lot of experts will disagree with me here, but personally, I kind of see a lot of these ETFs that are, you know, like SPY. I kind of see them as a bubble, just because, you know, when all these boomers start retiring, they're going to start pulling funds, and you never know when tech's going to tank, and maybe it won't, but I think diversity is key. And yes, this is outside of my 10% gambling rule of thumb, and this is more along the lines of in your brokerage account. Any other questions?
Wait, who are you using again?
For my fiduciary,
Yeah.
I'm using Personal Capital.
Okay.
And lastly, so this is to be continued. Once more people start bugging me about more advanced topics and overall investing, I'll make new slides, make a new deck probably. But this is just a general personal finance 101 for achieving FIRE. I I I feel that this is a good introduction for people that are brand new to this or vaguely aware of a lot of these concepts. Kind of went over like how people's spouses were the inspiration for this, and so this is probably the best way to get kind of inundated with this before you start getting into our more advanced topics, which we've gone over, like with Johnny's like options shit. If you're brand new to this stuff, you probably don't want to just dive into that. You'll be very fucking confused. Also, I want to point out, even if you follow a lot of this, and not necessarily my advice, but like a Dave Ramsey or just, Reddit's personal finance, if you follow that for the rest of your life, you're still going to be okay. You should still be able to comfortably retire unless the, global market economy collapses. This is also not all inclusive. This is mostly just high level and personal to what I do. Markets go up and down, new laws come into action, so a lot of this is subject to change. And the main takeaway from this is consistency is key for planning for the future. When you pick out your strategy, just be consistent and stick to it. At least, I guess, if you want to start switching up your strategies, I'd say before you do that, try to stick to a strategy for a year, maybe 2, maybe 3. And I think if you follow a lot of these concepts, you'll be surprised at how quickly your net worth will grow. And, you'll look back on where you started 5 years later, and I would be surprised if you're not impressed with where you're at. So, guess all in all, pay off debts, accumulate stacks, financial independence. Boom. Presentation over.
I have a question and a comment.
Yep.
Are you planning on repeating this when the ladies are here or whatever?
Yes, I think I should.
So I would only have added comment to when you're talking about the retirement accounts. Maybe add in the rule of thumb to like a baseline is to contribute 15% of your gross income to those accounts.
Okay. I like that. How do I edit this?
I mean, yeah, you need the ladies need to,
point, but that's like a gold standard kind of minimum that you should be trying to achieve.
Agreed. And if you can afford it, I still like with the current tax situation, which I think is going to change with next year with the Biden administration, I think maxing it out is a good idea if you can afford it.
Yeah, and if your significant other works, then they need to also max out their accounts because
Derek, can you add that note in here, please? Like into the chat so I can add it, because it's not letting me edit my shit while I present.
Yeah. My coworker, he's married, and he after a year or 2 years, he realized his wife wasn't maxing out her 401k, and he was like, "Are you trying to make me work longer?"
Yep. Dude, even when Rachel was making pennies, well, I guess compared to what she's making now, she was still doing all right. But even she was maxing out her 401k as an intern.
If you're looking for more stuff like this, Choose FI is a great podcast.
I should add that to the resources. Can you add that in the chat too? I'm gonna edit this shit right after.
Does that stand for to choose financial independence?
Yeah.
So, do you want to end the recording now, Johnny?
If you have more to add, I mean, it's 49 minutes already, so it's gonna be fucking huge.
Oh
so.
fuck. Yeah, just end it, please.